We have the rand trading around 7.28 against the dollar, and it looks like we've lost some of that momentum that built up last week and in the early parts of this week. I think last week we traded down to about 7.17. This week our best level 7.22, and that seems to have waned out at this stage.
Dead right, Stephen. I really think that 7.20 is providing a stubborn floor for the rand bulls out there. We have breached it to the downside, but those breaches haven't really been sustained. And every time it goes below 7.20, it kind of quickly rebounds. And as you say, we back up closer towards the 7.30 mark. The rand is really by and large range bound at the moment and taking its cue almost exclusively from international themes and sentiment. But there are some domestic factors as well that possibly rand participants are keeping an eye on.
Of course, while we have the euro also battling to break higher against the dollar after testing that kind of 128, 129 level, we also have locally the strike action, and it seems that the government is digging its heels and it's not willing to budge on that 7% increase it's offering to public sector workers.
Well, absolutely. I think we definitely reached a deadlock there on the strike side, and traditionally that would be a very big rand negative because obviously it counts against the economic recovery. It also can feed through into higher inflation if those wage settlements come out well in excess of prevailing inflation. But the rand seems to be ignoring that. It seems to be largely ignoring the mining rights debacle as well. So it just seems as though the rand is really, as you mentioned a bit earlier, taking its cue from these euro-dollar movements. And with the euro strength having run out of steam, it's no surprise that rand's strength against the dollar is also somewhat limited.
We also had those June retail sales numbers out yesterday, coming in at the upper end of expectations, 7.4% growth in the year to June. But it's really uncertain where those retail sales numbers are going to go in the next couple of months.
Well, that's it, Stephen. Of course, there were some low base effects and also the World Cup effect kicking in for that reading. And the big question is, of course, whether or not that momentum can be sustained once the World Cup sort of spending spree is out of the equation. We doubt it, and I think the rest of the market also doubts it, because if you look at what the FRA curve is saying, even though the numbers were well in excess of market expectations, the market is still not convinced that the Reserve Bank won't cut interest rates in September. They're still assigning a very hefty probability, basically an 80% probability that we'll get an interest rate cut before the year's out. And despite those strong retail sales figures, those expectations have remained in place.
We had Deputy Governor of the Reserve Bank, Daniel Manelli, speaking yesterday, highlighting a number of issues. Obviously that our economy is still very much exposed, or very vulnerable rather, to what happens globally. Also chatting about interest rates and exchange rates, Michael.
Yes, absolutely. They also touched on growth. They're expecting a 2.9% GDP reading this year. They think that inflation is by and large contained. The outlook they still regard as fairly favourable. They've acknowledged risks like wage pressures, administrative prices, but I think given that they regard inflation as under control, and given that they've also expressed concern about the strength of the rand and potential asset bubbles that could develop from all the strong portfolio inflows that are coming into South Africa, I think the case for another interest rate cut or a more aggressive reserve accumulation, or perhaps some kind of a Tobin tax is probably gaining momentum, and I think the remarks yesterday kind of add credence to those risks. So yeah, I think some very interesting remarks, but if anything, I think it is rand negative and possibly, as I say, conducive to more monetary easing.